October 2025. While most Canadians were focused on Bank of Canada interest rate cuts, one number flashed across developers' screens that changed everything: 12,000. That's how many brand new homes are sitting empty right now, finished, ready to move in, and nobody wants them. This is the highest unsold inventory level Canada has seen in 25 years. And it's happening in a country that's supposedly in a housing crisis. Canada's residential real estate market is worth $847 billion. Toronto alone accounts for over $400 billion of that. And in late 2025, we're watching every single classic bubble indicator flash red simultaneously. Is this the crash everyone's been predicting? Or something completely different? I'm digging into the October 2025 data that nobody's connecting. Let's look at what's really happening. Here's what makes this moment so fascinating. On the surface, Canada's housing market looks fine. The national average home price hit $676,154 in September. That's actually up 1% from last year. Sales are near long-term averages. The government says we're balanced, but when you zoom into the data, you see the cracks. Toronto home prices down 3.8% in 2025, expected to barely recover. Just 1.5% growth in 2026, according to TD Economics. Vancouver. Benchmark prices at $1.15 million, down 4% year over year. Detached homes? Down 8%. That's wealth evaporation in real time. And here's the kicker. Sales are actually rising heading into 2026. RBC forecasts 7.9% more transactions. So more people are buying, but prices are falling? This is the paradox, and it tells us something critical is happening beneath the surface. Economists love to debate when something becomes a bubble. But there are three classic indicators that show up right before major corrections, and all three are flashing right now in Canada. Warning. Sign number 1. Inventory. Explosion. Remember, that 12,000 number? Those are completed homes sitting empty. That's 50% above the long-term average. But it gets worse. In Toronto, housing starts are at their lowest level in 30 years. Not because we don't have permits. We hit a record 350,000 residential permits in August. Developers have permission to build. They're choosing not to. Why? Because they're sitting on mountains of unsold inventory. The pre-construction model, where you buy before building starts, has completely collapsed. Investors and buyers who used to purchase units 2 to 3 years before completion? Gone. Developers are now finishing buildings with zero pre-sales. That's never happened at this scale. Warning sign number 2, the Great Freeze sales to new listings ratio, 50.7%. That's technical market speak for balanced. But that national number hides what's really happening. Ontario and BC, markets are soft. That means buyers have power, real negotiating power for the first time since 2019. Active listings are up 7.5% year over year nationally. In a housing crisis, you'd expect listings to disappear fast. Instead, homes are sitting. In Toronto, properties are taking weeks longer to sell than they did 18 months ago. And here's the psychological shift. Buyers know this. They're waiting. They're watching prices soften month by month. Why rush when you know next month might be better? This creates a feedback loop. Waiting leads to more waiting. Prices soften more. The cycle feeds itself. Warning sign number 3. The $847 billion question. Let's talk about the big number. Canada's total residential real estate market, $847 billion. Toronto metro area alone, over $400 billion. Vancouver, significant chunk of the remainder. Now here's the math that keeps economists up at night. If prices correct just 5% nationally, which is less than what Toronto already saw in 2025, that's $42 billion in wealth that vanishes. Not less growth. Gone. If Ontario and BC see the 10 to 15% corrections some analysts are warning about, we're talking $85 to $130 billion wealth destruction. In the two provinces that drive Canada's economy, RBC officially forecasts a modest negative 0.7% national decline in 2026. But their Toronto forecast? Down 3.8% this year, then barely recovering. Vancouver, down 3.9% in 2025, then up 3.1% in 2026. That's still net negative by 2027. Those aren't bubble pop numbers. But they're wealth erosion on a scale Canada hasn't seen since the 1990s. So what changed? Why are we seeing this shift in late 2025 specifically? Four forces converging. Force number 1. The immigration pivot. Canada's housing boom from 2021 to 2023 was turbocharged by immigration. 500,000 plus people arriving annually. That's massive demand. But in 2025, the government hit the brakes. Reduced targets, tighter eligibility. The result? One of the biggest demand drivers just stopped. Developers built for the 2023 immigration numbers, but buyers are showing up at 2025 immigration numbers. That gap? It's those 12,000 empty units. Force number 2. The condo tsunami. 19,000 new condos completed in the GTA in 2025. Another 22,000 plus in the pipeline for 2026. Vancouver similar ratios. In normal times, pre-sales would absorb this. But investors, who bought 50 to 60% of pre-construction condos in the boom years, are gone. They got crushed by higher interest rates and negative cash flow. Now those units are completing. Developers need to sell. Fast. That desperation? It shows up as price cuts. Force number 3. Interest rate reality? Yes. The Bank of Canada cut rates in September 2025. And yes, they'll likely cut more heading into 2026. That should help, right? Here's the problem. Rates are still 2 to 3% higher than the 2015-2019 average. A $1 million mortgage at today's rates costs you $300 to $400 more per month than it did in 2019. Rate cuts help at the margin, but they're not bringing back 2020 affordability. And buyers know this. You're not missing out like you were in 2021. Force number 4. Economic fragility. Unemployment hit 7.1% in late 2025, highest since before the pandemic. Trade tensions with the U.S. are creating uncertainty. Recession risk is real if external shocks hit. Housing is the most sensitive asset to economic confidence. When people worry about job security, they don't buy million-dollar homes. They rent, they wait. They conserve cash. All four forces hit at once in 2025-2026. That's why this feels different. So what actually happens in 2026? Let's game out 3 scenarios. Scenario 1. Soft landing, 40% probability. RBC's base case, negative 0.7% national prices. Toronto, Vancouver, condos down 5 to 8%. Prairies stay flat or up slightly. No panic, no crash, just a long, slow grind lower. This requires no recession. Continued rate cuts. Immigration stabilizes. Buyers slowly re-enter. Takes until 2027-28 to find a true floor. For buyers, gradual improvement in negotiating power. For owners, paper losses, but manageable if you don't need to sell. Scenario 2. Regional correction, 45% probability. My base case. National decline 3 to 5%. But Toronto, Vancouver condos? Down 10 to 15%. Detached homes 5 to 8%. Suburban ripple effects. This happens if mild recession hits. Job market softens further. Inventory continues piling up. Sellers panic in Q1 2026 when they realize spring bounce isn't coming. Sales stay weak through 2026. Recovery not until 2028 plus. This isn't a crash. It's a 3 to 4 year correction. For buyers, real opportunities by mid-2026, especially distressed sellers. For recent buyers, equity hit, but survive if you hold long-term. Scenario 3, bubble burst, 15% probability, the worst case. National decline 10% plus. Toronto, Vancouver down 20 to 25%. Requires an external shock. Deep recession, major bank failure, global financial crisis 2.0. Foreclosure risk rises. Negative equity common for 2022-2024 buyers. Multi-year recovery like 1990s Toronto. Probability is low because banks are better capitalized. CMHC provides backstop. Government will intervene if it gets this bad. But low probability doesn't mean zero. And the setup is there if something breaks. So is Canada's $847 billion housing market crashing in 2026? The honest answer, it's not crashing. It's correcting. And we're already 6 to 12 months into it. Toronto and Vancouver have been softening all of 2025. The question isn't if it continues into 2026, it's how much a crash is dramatic, sudden, panic-driven. This is gradual, measured, and inevitable after the 2020-2022 bubble. Prices went too high too fast. Now they're normalizing. For buyers who waited, you were right. Patience is paying off. For owners who bought pre-2021, you're fine. Hold. For owners who bought 2022-2024, rough 2 to 3 years ahead. But survive if you don't panic sell, the bubble isn't popping. It's deflating. Slowly. Painfully. And 2026 will tell us if the air comes out smooth or if something ruptures. Here at Maple Money Data, we release new analysis every weekday, Monday through Friday. Subscribe so you don't miss the updates. Check the description for our full Canadian housing market playlist and all sources used in this analysis. We're Maple Money Data, analyzing Canadian finance data every week.